The average UK home is worth £268,000 right now. That number went up 1.3% last year. So you would think everything is fine. But Lloyds Bank just released their annual data, and buried inside it is a list of towns where prices did not go up. They went down, and not by a little. One town in the southeast lost nearly 9% of its value in a single year. On a £400,000 home, that is roughly £36,000 gone. That is more than the average UK salary. While the headlines keep telling you the market is recovering, entire towns are quietly losing tens of thousands of pounds per property, and nobody on the news is talking about it. If you own property in any of the places I am about to cover, or if you are thinking about buying in one of them, this one matters. Right, number 10 on the list. Stockport, Greater Manchester. Stockport sits about 7 miles south of Manchester city centre, population around 295,000. Average home values here dropped 4.7% in the year to October 2025, according to Lloyds Bank data. That is £16,289 wiped off the average property, bringing it down to £330,654. And that drop happened while the Northwest as a whole grew 3.7%. So, Stockport is not just underperforming the country, it is underperforming its own region. Part of the issue is that Stockport has higher average prices than many of its neighbours. When you can buy in Wigan, which grew over 10% last year, or get more space in Salford or Oldham, buyers with stretched budgets are doing the maths and choosing elsewhere. Stockport's famous Market Hall and Viaduct make for cracking photos, but the numbers say buyers are voting with their feet. The trajectory here suggests Stockport needs to close the value gap with its neighbours, or the drift could carry on well into 2026. Number 9. Barnsley, South Yorkshire. Barnsley is about 15 miles north of Sheffield. Population roughly 250,000 across the borough. Property values here fell 4.7% in the year to October 2025, with £10,624 knocked off the average home, bringing it to £215,552. Now, that is a smaller cash loss than some of the places further up this list, but at these price levels, proportionally, it stings. Barnsley's economy has been rebuilding since the mining days, and there has been genuine investment in the town centre and digital campus. But the local jobs market still lags behind Leeds and Sheffield. And when buyers can reach either of those cities in under 30 minutes, the pull to spend more in a bigger hub is real. If you have been to the Barnsley market, you know it is one of the best in Yorkshire. Proper good, but a great market does not prop up house prices when the fundamentals are not there. The data points to a town that is still finding its footing in a region where cities like Leeds are soaking up most of the demand. Number 8. Brighton, East Sussex. Brighton sits on the south coast, about an hour from London by train. Population around 277,000. Average property prices fell 4.8% in the year to October 2025, according to Lloyds. That is a drop of £20,254, bringing the average to £404,874. Brighton has long been one of the most expensive coastal cities in the country, and that is part of the problem right now. The pandemic sent prices surging as remote workers from London piled in, chasing the sea air and cafe culture. But the premium that built up during that rush is now unwinding. Mortgage rates above 4.5% hit harder when your average property is north of £400,000. Monthly repayments on a £320,000 mortgage at 5% come out at about £1,870. A lot of buyers are looking at those numbers and deciding that the Brighton lifestyle tax is too steep when they could get a 3-bed in a dozen other coastal towns for half the price. Rents, meanwhile, are still climbing. That gap between falling sale prices and rising rents tells you that people want to live there. They just cannot or will not buy at these levels. Number 7. Cheltenham, Gloucestershire. Cheltenham is in the west of England, about 9 miles from Gloucester. Population roughly 120,000. Prices here dropped 5% in the year to October 2025, with £21,616 coming off the average property, landing it at £411,593. Cheltenham is known for its Regency architecture, its racecourse, and GCHQ. It has a reputation as one of the more well-to-do towns in the southwest. And that is exactly why a 5% fall matters. When your average home costs over £400,000, a 5% drop is not a rounding error. That is the kind of money that turns a comfortable amount of equity into a tight one for anyone who bought in the last 3 or 4 years. The Southwest more broadly saw some of the wildest price swings during the pandemic property boom, especially in lifestyle. Locations. The correction playing out in Cheltenham mirrors what is happening in other high-value towns, where prices ran well ahead of what local wages can actually support. Cheltenham's Gold Cup brings in millions every March, but the property market is running a rather different kind of race right now. Number 6. Cardiff, Wales. Cardiff is the Welsh capital, population around 370,000. Average property values fell 5.2% in the year to October 2025. A cash drop of £17,079, bringing the average to £310,577. What makes Cardiff interesting is context. Wales as a whole saw house values rise 2.3% over the same period. So this is not a Welsh problem, this is a Cardiff problem. The city saw solid growth through the pandemic years, and now it is giving some of that back. Higher stamp duty thresholds introduced in Wales, combined with stretched affordability in the capital versus the rest of the country, are pushing some buyers toward the valleys and Swansea, where prices are significantly lower. Cardiff Bay and the city centre have had massive investment over the past decade, but investment does not guarantee price growth when mortgage rates squeeze what people can borrow. The ONS data through to January 2026 shows Wales still growing at 2%, so the areas around Cardiff are absorbing the demand that the capital is losing. Number 5. Worcester, West Midlands. Worcester sits along the River Severn, about 30 miles south of Birmingham. Population around 105,000. House prices here fell 6.1% with £21,724 stripped from the average property, bringing it down to £331,977, according to Lloyd's. Worcester is one of those towns that looks brilliant on paper. Cathedral city, good schools, decent rail links to Birmingham. But it is caught in a strange middle ground. It is too expensive compared to somewhere like Stoke-on-Trent, which is growing and far cheaper. And it is not quite connected enough to compete with Solihull or Warwick for Birmingham commuters willing to pay a premium. When you are in that middle zone, rising interest rates push you out of favour fast, because buyers at every price point can find something they think is better value just up the road. Worcester's famous cricket ground and porcelain heritage give the town real character, but character does not pay a mortgage. The correction here looks like a pricing reset. And if Birmingham's economy keeps pulling commuters toward closer suburbs, Worcester may take a good while to recover. Number 4. Solihull, West Midlands. Solihull borders Birmingham to the southeast, population about 215,000. Property values dropped 6.2% in the year to October 2025, a cash loss of £25,976, bringing the average to £390,292. Nearly £26,000 lost in 1 year. On a property worth just under £400,000, that is the kind of drop that makes you check the numbers twice. Solihull has always been seen as one of the most desirable places to live in the Midlands. Good schools, green space, close to the NEC and Birmingham Airport. The problem is that desirable and affordable are not the same thing. And when mortgage rates climbed, Solihull's price premium became a harder sell. Buyers who might have stretched for Solihull 2 years ago are now looking at Tamworth, Redditch, or even parts of Coventry, where the same mortgage payment gets you a bigger house. HS2 was supposed to be a game changer for Solihull, with the interchange station at the NEC. But uncertainty around the project's northern legs and shifting timelines have taken some of the shine off that story. When the main growth narrative for an area stalls, the prices that were baked into that narrative start to soften. That is what the 6.2% drop is telling you. Number 3. Chester, Cheshire. Chester is in the northwest of England, right on the Welsh border, population around 130,000. House prices here fell 6.4% in the year to October 2025, a loss of £23,114, bringing the average to £340,415. And just like Cardiff, this happened while the Northwest as a region was growing at 3.7%. Chester has always traded on its Roman heritage, its famous rose, and its reputation as one of the prettiest cities in the north. It draws tourists and day trippers year-round, but prettiness has a price, and that price has become harder to justify. The local economy relies heavily on retail, tourism, and professional services, but it does not have the kind of large-scale employer base that anchors housing demand the way Manchester or Liverpool does. Those two cities are both within an hour, and both offered stronger growth last year. Liverpool made it into the top 10 fastest growing towns in the Lloyd's data. Chester did the opposite. The ONS data for the broader Cheshire West and Chester area actually shows prices rising 2.8% in the year to December 2025, which means the city of Chester itself is being dragged down while the wider area holds up. That kind of split usually means the city's price ceiling has been reached. Buyers can get more for their money in the surrounding towns and villages. So they do. Number 2. High Wycombe, Buckinghamshire. High Wycombe is in the Chiltern Hills, about 30 miles west of London, population roughly 135,000. House prices fell 7.4% in the year to October 2025, according to Lloyd's. That is a cash loss of £34,994, bringing the average down to £436,379. Nearly £35,000 gone in 12 months. On a 90% loan-to-value mortgage, that kind of drop can wipe out a buyer's entire deposit and then some. High Wycombe has always been a commuter town. The Chiltern Railways line gets you into Marylebone in under 30 minutes, and that rail link used to be the whole pitch. But the hybrid working shift has changed the maths. If you are only going into London 2 or 3 days a week, the premium you pay for a fast commute shrinks. And when you factor in that the average home here costs over £430,000, buyers are asking themselves whether they really need to be in High Wycombe when Reading, Swindon or Milton Keynes all offer more house for less money. Sales volumes in High Wycombe are also down. Property Solver's data shows transactions fell about 15% in the past year, and the average gap between asking price and sold price is running at about -2%. Sellers are listing at one number and accepting offers well below it. When volume drops and discounting rises at the same time, it tells you the market has not found its floor yet. The Zoopla data also flagged the broader southeast as one of the weakest regions for 2026 growth prospects, with sellers increasingly cutting asking prices by 5% or more just to get a deal done. High Wycombe is caught in the middle of that correction, and the numbers suggest it has further to fall before it settles. Number 1. Crawley, West Sussex. Crawley is right next to Gatwick Airport, about 28 miles south of London, population around 120,000, and Crawley tops this list with an 8.9% drop in average house prices in the year to October 2025. That is a cash loss of £36,317, taking the average from £408,519 down to £372,202. Let that number sit for a second. If you bought a home in Crawley a year ago at the average price, you have lost more than £36,000. That is roughly the cost of a brand new car. Gone. Crawley's economy is heavily tied to Gatwick Airport, which is the town's largest employer. The airport and its surrounding logistics and hospitality businesses drive demand for housing. But air travel's post-pandemic recovery has been uneven, with cost of living pressures keeping some leisure travel subdued, and business travel still below 2019 levels in many sectors. Meanwhile, Crawley has a lot of newer housing stock, including large developments that went up during the mid-2010s. When you have a town with a concentrated employer base, a lot of relatively similar housing and stretched affordability, a correction can be sharp because every seller is competing with the one next door. The wider southeast picture makes this worse. The region saw the most towns in Lloyd's bottom 10 for price performance. Zoopla's 2026 outlook ranked the southeast toward the bottom for growth prospects. Canterbury had nearly 20% of its listings, with asking price cuts of 5% or more. The southeast is going through an affordability reset, and Crawley is right at the front of that queue. Transaction volumes in Crawley dropped over 21% in the past year, according to Plumplot data. Fewer buyers are showing up, and the ones who do have the leverage to negotiate hard. On the Plumplot figures, the average Crawley property is back to being worth roughly what it was several years ago when you adjust for inflation. If you are a homeowner in Crawley, your property has not just lost value in cash terms. In real terms, factoring in inflation, the loss is bigger still. The one thing Crawley has going for it is that Gatwick is not going anywhere. The airport is a permanent economic anchor, and if the broader economy picks up and travel fully recovers, demand will come back. But that is a long-term bet, not a short-term comfort. So here is the big picture. The UK housing market is not crashing nationally.